Today we're going to continue our discussion on candle patterns, and we're going to talk about making money on the days that it's easy to make money on. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Wednesday, we're in the midst of a lot of market turmoil. We've had some big days in the market. Indexes, crude oil, the currencies. Today we're going to continue our discussion in our simple Forex strategy, talking about big geometric patterns, the high of the day, the low of the day, the importance of those, the importance of market timings, the importance of round numbers, price patterns that can confirm our thesis in terms of entering the market with tight risk reward, okay, asymmetrical risk reward, where we're targeting more profit than we're risking to take the trade. We talked about taking profits, cutting losses, and we're going to talk a bit more about the bigger picture geometry, because we're in an historical moment, I think, for a lot of traders. These types of events don't come along that often, every 10 years, maybe longer. Right now we're experiencing volatility in a lot of markets, in commodities, indexes, currencies. This is the perfect storm for traders who are patient. But also we're going to talk about not trying to trade every move in the market. A trader, one of my mentors, told me years ago, you make money on the days that it's easy to make money. And when you start to identify, we've talked about targeting one or two specific types of setups. We look at a basket of currencies to try and pick the one pair or the couple of pairs that demonstrate those setups may be presenting, and then looking to see how that matches our thesis in terms of our other criteria, and then positioning ourselves in that market to hopefully get 3, 4, 5, maybe 10 to 1 on our risk. And again, those are the days that you make a lot of money trading on. Now, the last couple of days we've seen the spreads widen out. We've seen volatility. We've seen 50, 100 pip swings back and forth on a couple of the exotics, New Zealand, Aussie, pound crosses. Still some great opportunities to enter the market with tight stops on smaller time frames. One of the things that we can talk about when you get into that sort of volatility is going down to smaller time frames, because the 15-minute chart is a little bit too volatile to read, but the 5-minute chart can give a lot more simplicity to the patterns that we look for at round numbers. But today we're going to just talk a bit more about the candle formations, the engulfments, the 1, 2, 3s, and the pin hammers. We're going to go through some screen examples as well on the charts. Essentially, what we look for with the engulfment patterns is where the market has, we talked about 3 pushes. I've talked about using the timings of the market equity opens, but also the hourly phenomena. And sometimes we'll see that happen in the first hour of that 12 candle window, maybe the second candle. I have basically a golden rule. If I don't see it in the first hour, I look for it at the end of the second hour when London opens. Now, this time change the last few weeks has thrown a lot of people out, because London hasn't gone back to daylight savings time yet. But one of the things that's important is that in that 12 candle window, we've still seen the market behave with price action patterns. Now again, the engulfment candle is when we see in a sell situation something up near the high of the day at numbers where a bear candle will completely engulf the wick of a bull candle. Now there are some other 3 and 4 bar combinations, but for simplicity's sake, we're going to stick with the basic 2 bar pattern. Now we may have some other price action that coincided with this. It could have been 3 pushes, it could be a head and shoulders, it could be a triple top, it might even be just a double top. But that engulfment will be the confirmation where traders can enter into the market short. Now, some traders will enter in right here at the close of this candle. Now, what's important is that we talk about once your thesis has been confirmed, the next step is to fight for the best price. Now, sometimes the market may take off and not give you a second chance to get in closer to the numbers. And that's the dilemma that you face sometimes in a fast-moving market like we've experienced in the last few days. So some traders will make the decision to take a position and maybe add in other positions for an averaged in fill. I don't like to do that. I will often, typically, depending on how far we are from the numbers, enter in somewhere on a 2 or 3 pip pullback if I think the candle is too large. If this is the second or third hit to the high, especially on a third hit to the high, I will often enter in, because on the third push to a high and the engulfment happens, you will often not get a chance to get a fill back towards the numbers. So if it's the third push, and we'll often see this sometimes on a pattern where we'll get a midweek M pattern form, and then the market will do 1 push, 2 push, 3 pushes underneath, and then a shift candle. And that shift candle does not come back. So traders who try to limit order up closer inside of there will not get filled. Now, often those engulfments may occur very close to numbers. I don't worry. I get into the market. I put my stop in place. My thesis is that if that's locked in the high for that session, or even for the day, I'm prepared to lock it in and set my profit target. Or if I'm going to follow that trade throughout, if it's a trending type situation, but as soon as I'm in, I put my stop in place and I'll enter into the market. The same goes for a long trade back in the opposite direction. We may get some sort of bottoming formation that happens, and then the market will work back with 3 pushes down and shift away. And that will often happen in a Wednesday, Thursday, low of the week, high of the week situation. Now, the 1, 2, 3, specifically, whenever the market makes 3 bars in one direction, 1, 2, 3, to a high or to a low, that can often be, number one, a reversal, or it can be a measured move. Now, often when I see a 1, 2, 3 on a second extension out, so if the market has already come down and made a low, gone sideways, and then gone 1, 2, 3, and we're at timings, we're heading into New York, whatever that is, and we get a 3-bar reversal off of a 1, 2, 3, I will position myself again into the market. Now, the market may come back and test the numbers before it heads off, but again, this 1, 2, 3 is a very powerful reversal pattern, and the same thing goes for the short direction as well. If we see this 1, 2, 3 come off of a 1, 2, 3, so we have 1, 2, 3 up, 1, 2, 3 down, that will often be a reversal as well for a measured move. Again, whenever you see 3 candles in one direction on any time frame, be prepared for a reversal. If the market was to break out to new highs on a 1, 2, 3 out of a range, you might see an inside bar consolidation for the measured move back in with the direction of the trend. But the important part of the 1, 2, 3 that I want you to get out of this is that if that's a second leg of an extended out stop hunt or extended out move, that market is more than likely getting prepared to reverse, especially if it's heading into the equities open. So these are the types of patterns you'll see in the hour prior to an equity open. That can be the final blow off before the market reverses heading into the next session. Now, if that was to occur coming out of London and the markets drop 25 to 50 pips, we could expect possibly to see a measured move back in the same direction of that trend. 1, 2, 3. Slowly decelerating candle momentum, and then a large engulfment. Whenever you have that type of situation, there's a high probability that the market is about to reverse, especially at numbers. Now, the third one we talked about is pin hammers. We'll just separate these two. So this would be a short and a long. Now, again, this is putting this into context with our other market dynamics. So, for example, the market has been coming down, or it's been going sideways, and then we get our pin hammer at numbers heading into a market open. Again, timings are critical. The most important thing to remember is timings. The timings is when things are going to happen. When the market's open, when the banks go to work, that's when we go to work. This pin is representation that they are done doing business down here. So again, we're not talking about in the middle of a strong move in the middle of the London session, the market breaks out and gives you a pin hammer in the middle of a range, that more than likely is a trap that can be rolled over for a measured move. We're talking about the market heading into the opens, the low of the day or the high of the day, at the equity opens, and the market possibly has already come down 25 to 50 pips and gone sideways, and vice versa, gone up 25 to 50 pips and gone sideways. It may just be going sideways at numbers, but that pin hammer combination reversal, once you see that tail, the next thing you want to do is fight for the best price. If that market gives you the best price, that formation gives you the best price, then get in, put your stop in place, and then your target. We're going to go through some chart examples of these. The other things that I want to talk about, again, big picture geometry. We talked a couple weeks ago about the pound yen on the Friday, the possibility of a measured move. Stop trying to trade every move in the markets. You identify 2 or 3 simple setups that have the potential to move 5 or 10 times your risk. Those are the days that you make all your money on. Trying to trade chop and volatility with 10 and 20 pip spreads is going to get you frustrated. It's going to get you possibly damage your financial capital and your psychological capital. When you step back and realize that right now the opportunities that we have presenting to us in the market are going to give some traders, possibly set them up for the rest of their lives. I read yesterday that Goldman's has a target on the Dow of the S&P of 2,000 at some point in the next 6 to 8 months, and they'll figure we'll end the year at 3,200. Now, technically speaking, we have pound cross pairs that have fallen in 2 weeks down to almost multi-year lows. Multi-year lows. So these pairs have the potential to retrace a large portion of those, and maybe even more if we head back to pre-Brexit levels on those pairs. Just bear that in mind. Master some simple setups. We're going to look at a couple of anchor point trades. So that was the third thing that I wanted to talk about, is anchor point trades. Anchor point trades, trend trades, whatever you want to call them. They show up intraday and they show up on our daily lows and highs. When the market pulls back, if we have a down day and the market gives us a low of the day and pulls back and goes into consolidation, if the market is working the high of the day in the next Asian session, in whatever form it presents in, that low of the day is a target for a measured move if the market decides to roll over and come through that level. It may only come through and stop on it, but if there's a candle formation pattern that gives us a sell high setup back with the original move that formed that anchor point low, we have the potential to do a measured move. And if we go back to our ADR rules, if the market has an ADR opportunity of 150 or 100 pips, whatever that is, and this is a 50 pip pullback, that market has the potential for 100 from high to low or more in a strongly moving market. We've had several of these trade setups on some of the US cross pairs as well as some of the pound cross pairs. Now, the same principles apply in the long direction. When we have a high in place and the market pulls away and works the low of the next session, we have the opportunity that that market may give us again a candle formation that gives us an entry back in the original direction of that anchor point high. You can call them trend trades, we can call them anchor point trades, whatever you like, and they do show up again intraday off of pin lows and pin highs. So something to think about when a market gives you a big pin bar or a big railroad track engulfment reversal. Are they working away from that point and not going anywhere for the reversal at numbers, again in the long direction, or are they breaking to new levels in a reversal for a trend in the other direction? Because those anchor point trades offer you the potential for measured moves. So if you start doing the math and you get into a trade, instead of targeting 50 pips, start looking at where that anchor point is, and we talked about using the measurements, range expansions, 100%, 200% expansion of those ranges to target bigger and bigger profit targets. So again, squeezing as much out of a winning trade as you can, keeping your risk tightly controlled, and then we're going to get into smaller time frames when these trades present, because when you can get your risk tight and you have the opportunity for 10 to 1 trade, you can maybe even get that up even bigger. So hopefully you got some value out of that, traders. Again, keep it simple. Simplicity. You can duplicate this. You can duplicate this every single day. And we are going to have some massive opportunities in these markets. Stay disciplined, stay focused, and may the markets go with you.
Okay, traders, just continuing with our discussion on candle patterns. We just went over engulfments, pin hammers, and some 1, 2, 3 patterns. And specifically, we talked about the high of the day, the low of the day, the timings of those patterns presenting. So obviously, we want to be positioning ourselves at or near the high of the day when the market opens, when the price action confirms that for us. And particularly, we're looking for those patterns to either come off the high or the low of the day or at round numbers, 50s and zeros. So here's some examples the last few weeks. Pound New Zealand, we've got a 1 push, 2 push, 3 push pattern with engulfment. Engulfment in the middle, pin hammer on the far left of that first leg down, occurring at round numbers, double zeros. Market auctioned up, gave 2 pushes and came back down again, went up, made a new high of the day, and then into the US session gave us a 1, 2, 3, which we talked about, pins, and then the engulfment for the big move back up. And again, you can see at the top, we end up going 1, 2, 3 to the high, and then a big shift candle, and then going sideways into the close. So the 3 patterns that we talked about specifically were pin hammers. We're looking for evidence of pins anywhere we can see them, not necessarily just as a one-off entry point, but in context with the price action and the timings. We then see the market go sideways at round numbers, and again, traders would get trapped on this false carry through engulfment, which is at the low. So again, we're not looking for these sort of patterns near a low or high in the opposite direction. We're looking for the reversal setups. And then again, we get the engulfment on top of the numbers after the 3-bar reversal pattern in the middle. And then in the US session, we get the big pins washing out the low of the day, hitting all the stops, hitting them a second time, consolidating and giving us the engulfment. We talked about how these may pull away from the numbers, and in this particular case also the previous day's low of the day, and where the market will retest those levels, sometimes putting stress on traders. But again, if your stop is at the low or a distance away, some traders will wait for the limit order opportunity. We're not always guaranteed that in a fast moving market. As you can see up top, the market pulled away quickly, making traders chase price. Whenever you need to chase price, be suspicious that they are going to revisit that level at some point. When they pin that level, you can feel fairly confident, especially on a double candle formation like an engulfment and then a doji pin hammer, that market is done doing business down at that level and is going to shift away to target the previous higher low. Again, another example, heading into the US session, taking out the previous low of the day and the current low of the day, pin hammer, a pullback, and then a reversal and shift candle. Again, traders forced to chase price if they were not in the market somewhere in this area. And again, if you ever chase the price and the market moves away, you can feel rest assured that at some point they will come back to revisit that level and fill the gap. But also, they're giving you a worse fill. And when that market goes sideways, it doesn't take much to trap traders who are caught further away from the low of the day. And again, the market consolidates after stop hunting high, filling the gaps, gives a pin hammer into the close for a 150 pip move back towards the breakout at the US session. Again, an example of an anchor point trade. The market takes out the previous low of the day and pulls away, and in 3 pushes over the course of the Asian session works the high of the day. 1 push, 2 push, 3 pushes, doesn't go any higher. Pins on top, we get an engulfment heading into the Asian close to where it goes sideways, and the market breaks through in the London session and concludes a measured move of the pattern from the anchor point below. So whenever you see an anchor point, whether it's at the end of the day, the beginning of the day, and the market works 3 pushes away, you can look for the opportunity for that measured move trade, double the distance. Again, another example, yesterday or on Monday on the British pound, anchor point trade, the market pushed 3 pushes away, 75 pips roughly, and then went 1, 2, 3 into the end of Asia before dropping down and giving a breakout pullback, continuation entry. So again, we see a 3 multi-bar engulfment after a stop hunt candle at the London Open for a measured move of twice the rectangle from the anchor point. Just again, another example of when the market rolls over, these are the days that you want to participate in. They're the days that potentially are the easy days to make money. And if you get that opportunity, these are the days that you can feel confident to position yourself with a reasonable amount of risk with a tight stop and possibly 10-to-1 return on your trade size. Again, another example of the type of days that I look for where the market has been moving in one direction and it continues to do so without much resistance before consolidating into a bigger geometric pattern and giving us engulfments of peak formation candles for measured moves of more than 10 times your risk. Again, try to identify your best trade setups when it's easy for you to make money on. Trading a lot of volatility or markets with a lot of spikes in both directions is not easy and is not stress-free trading. Try to make your trading stress-free. So again, another example following through the day after where the market immediately went up almost 200 pips before consolidating. We've looked at this. This was 2 weeks ago on the pound yen. We had a double top formation at the end of the Europe changeover rate at the London Open, a pin hammer to the high at numbers for a measured move down back to the low of the day. Again, another example of a trade where the risk reward is asymmetrically skewed 10 times almost in your favor. Nothing's guaranteed, but we're looking for opportunities at the extremes of the market when the market's price action confirms that for us to enter the market with an asymmetrical risk reward. So again, just an example again of a 1, 2, 3. We talked about 1, 2, 3 where the market has given pins, but can also be an example of a measured move taking place. The inside bar, the double inside bar in this case, was broken to the long side for another 1, 2, 3 stop hunt to the high underneath of the previous day's low. And again, that candle pulled away in one engulfment for a 100 pip move down, almost 150 pip move down. And again, another example of where the market pulls away and makes you chase the trade. When you see that, most likely the market will return at some point to fill that gap. Important to not only be moving your stop to break even at some point, but taking profits off the table, especially when a stop hunt has taken place. Next day, we see another example of an anchor point trade from the previous low of the day. The market, even the low of the beginning of the session, moves away in 3 pushes, heading into the end of Asia. Pin hammer, pins at the high, pin hammer at the end of the 12 candle window for moving down for 100 pips back to the low of the day. Again, another example of 5, 6, 7 times profit target opportunity. Doesn't mean the market's going to get there, but we're targeting that if the market pulls away strongly in the direction of our thesis. So again, just keep it simple, traders. We're looking for engulfments, pin hammers at the low of the day, high of the day, reversal type setups back with the original trend or off of the low or off of the high for a measured move back to the other side of the market. Keep it simple. Stay disciplined, traders. Target asymmetrical risk reward. Look for simple candle patterns. Look for evidence of where the market has done doing business in this area and is possibly going to be reversing to the other side. Have a great trading day, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.